Here's a question. If I offered you two choices right now, choice A, I hand you $1,000 guaranteed, or choice B, you flip a coin, and if it's heads, you get $2,500, but if it's tails, you get nothing. Which one would you pick? Most of you just picked choice A, the safe $1,000. I know you did. Now, what if I told you that the reason you made that choice is the exact same reason you're sitting on the sidelines while your money loses value every single year? The same reason you haven't started investing yet, even though you know you probably should. What if I told you your brain is literally wired to keep you poor? Stay with me, because in the next 15 minutes, I'm going to show you the psychological trap that's been sabotaging your financial future, and more importantly, how to break free from it. Let me paint a picture you might recognize. You've got some money saved up. Maybe it's $500, maybe it's $5,000. It's sitting in your checking account or maybe a savings account, earning, 0.5% interest? Basically nothing. Your friend, your brother, that one co-worker who won't shut up about it, they keep telling you should invest that, put it in index funds, you're losing money to inflation. And you know they're right. You've watched the videos, you've read the articles, you understand that inflation is eating away at your purchasing power. But every time you think about actually moving that money into the stock market, something stops you. Your stomach tightens a little. You think, but what if I lose it? What if the market crashes right after I invest? What if I pick the wrong thing? What if there's a recession? So you do nothing. You tell yourself you'll wait, you'll do more research, you'll wait for the right time, next month, next year, when things are more stable. Sound familiar? If you're nodding right now, you're not alone, and you're not broken, you're not dumb, you're not even being irrational. You're just human.
And your brain is doing exactly what it was designed to do, which, unfortunately, is terrible for building wealth. What you're experiencing has a name. It's called loss aversion, and it's one of the most powerful psychological forces affecting your money decisions. Here's what it means. Research shows that psychologically, the pain of losing money is about twice as powerful as the pleasure of gaining the same amount. Think about that. Losing $100 feels about twice as bad as gaining $100 feels good. This was discovered by two psychologists, Daniel Kahneman and Amos Tversky, and eventually won a Nobel Prize because it's that fundamental to how humans make decisions. Let me show you how this plays out in real life. Remember that coin flip I mentioned at the beginning? Let me give you the math. Choice A, guaranteed $1,000. Choice B, 50% chance of $2,500, 50% chance of zero. If you do the math, choice B has an expected value of $1,250. Mathematically, it's the better choice. You should pick it every single time. But most people don't, because the possibility of walking away with nothing, the loss, feels so much worse than the potential extra $250 feels good. Your brain isn't calculating expected value. It's protecting you from loss. Now, you might be thinking, okay, but why? Why would our brains work this way? Great question. Let's go back, way back. Imagine you're one of your ancestors living 50,000 years ago. You're out gathering berries. You found a bush with enough berries to feed your family for 2 days. Now you hear there might be a bigger berry bush over the hill, could feed your family for a week. But you'd have to leave these berries behind, and there's a chance that berry bush doesn't exist, or it's already been picked clean, or there's a predator near it. What do?
You take the berries you have, every single time. Because in that environment, loss could mean death. Losing your current food source could mean your family starves. The potential gain wasn't worth the risk of loss. Our ancestors, who were really good at avoiding losses, survived. They passed on their genes. The risk takers, a lot of them didn't make it. So your brain evolved to be a loss-avoiding machine, and for most of human history, that was perfect. But here's the problem. The modern stock market is not a prehistoric savanna. The rules have changed, but your brain hasn't. Let's talk about what loss aversion is actually costing you. Because here's the brutal truth. While you're trying to avoid the possibility of loss, you're guaranteeing it. Let me explain. Say you have $10,000 sitting in a savings account. You're thinking, great, it's safe, I'm not losing anything. But inflation is running at 3% per year. That means next year, your $10,000 can only buy what $9,700 could buy today. You didn't lose any money, you still have $10,000 in your account, but you lost purchasing power. In 10 years, with 3% inflation, that $10,000 has the buying power of about $7,400 in today's dollars. You've lost $2,600 in value by trying not to lose anything. Meanwhile, historically, the stock market has averaged about 10% returns per year over the long term.
If you'd invested that $10,000 in a simple index fund 10 years ago, even with the ups and downs, the crashes, the scary news headlines, that money would be worth around $26,000 today. That's $16,000 you left on the table, not because you made a bad decision, but because you were afraid to make any decision. Loss aversion doesn't protect you, it just changes what you're losing. Instead of risking temporary market fluctuations, you're losing guaranteed purchasing power and opportunity. So, how do we fix this? First, we need to reframe what loss actually means. When most people think about investing, they imagine putting money in today and tomorrow it's gone. Poof, zero. But that's not how broad market investing works. Yes, the market goes down sometimes. In 2022, the S&P 500 dropped about 18%. Scary, right? But here's what loss aversion makes you forget. The market has never stayed down forever, not once in history. Every single person who invested in a diversified portfolio and held it for 20 years has made money. Every single one. The loss you're afraid of, it's not a loss, it's temporary volatility. It's just noise. The real loss is what happens when you don't invest. Let me tell you about my friend Sarah. Real person, changed her name for privacy. Sarah had $15,000 saved up in 2015. She wanted to invest it, but she was terrified. The market seemed too high. She kept waiting for a crash so she could buy the dip. 2016, market went up. She waited. 2017, market went up again. She waited. 2018, market went down a bit, but she got scared and waited for it to go lower. 2019, market recovered and hit new highs. She waited. In 2020, she was so frustrated with herself. Finally, in March 2020, the pandemic hit. Market crashed. She thought, this is it. This is my moment. And she was too scared. What if it goes lower? If she'd just invested that $15,000 in 2015, even with all the ups and downs, it would be worth over $35,000 today. Instead, it's still $15,000, actually less after inflation. The fear of loss caused the exact outcome she was trying to avoid. Okay, so how do we actually overcome this? You can't just shut off millions of years of evolution, but you can work with your brain instead of against it. Strategy number 1. Reframe investing as paying your future self. Don't think of investing as risking your money. Think of it as paying your future self.
You're not gambling, you're moving money from your present self to your future self, with interest. When you frame it that way, not investing becomes the risky choice. Strategy number 2. Automate everything. Loss aversion is strongest when you have to make active decisions, so don't. Set up automatic transfers from your checking to your investment account, same day every month. You never see it, you never have to decide to invest it. Your brain can't freak out about losses if you're not actively watching every fluctuation. Strategy number 3. Start embarrassingly small. You know what completely neutralizes loss aversion? When the potential loss is so small it doesn't matter. Start with $50 or $20 or literally $5. I'm serious. The point isn't the amount. The point is building the habit and desensitizing yourself to market movements. When you see that your $50 went down to $47 one week, then back up to $53 the next week, your brain learns, oh, this is just what it does, and I'm okay. Then you can gradually increase. Strategy number 4. Never look at your portfolio when you're emotional. Set specific times to check your investments, once a month, once a quarter, whatever. But not after watching the news, not after your coworker mentions a crash, not when you're anxious at 2 a.m. Loss aversion is amplified by emotion. Don't make decisions in that state. Strategy number 5. Remember this number, 20. Every time you feel scared about market drops, remember 20 years. Anyone who's invested in the broad market for 20+ years has made money. Every single one. If you're investing money you won't need for 20+ years, temporary drops are completely irrelevant. They're not losses, they're sales. Everything you want to buy just got cheaper. Here's what I want you to understand, and I mean this. Your fear is valid. It makes sense. There's nothing wrong with you. But staying in fear is not protecting you. It's hurting you. And the most painful part? The regret.
I've talked to hundreds of people about money. You know what I almost never hear? I regret investing too early. But you know what I hear all the time? I wish I'd started 10 years ago. I wish I'd started when I first learned about this. I can't believe I waited so long. Don't be that person. Your future self is depending on you. Not to be perfect, not to time the market, not to pick the perfect stock, just to start. To take scared action, to feel the fear and do it anyway. Because here's the beautiful thing. Every single successful investor was once exactly where you are right now. Scared, uncertain, worried about making the wrong choice. The only difference between them and you is that they started anyway. So here's what I want you to do. Not tomorrow, not next week, today. Step 1. Open a brokerage account if you don't have one. Fidelity, Vanguard, Charles Schwab, they're all fine. Pick one. It takes 10 minutes. Step 2. Invest an amount that would feel almost stupid to worry about. For some of you, that's $25. For others, it's $100. Whatever number makes you think, even if I lost this, I'd be fine. Step 3. Set up automatic investments. Same amount every single month. Step 4. Close the app and don't look at it for 30 days. That's it. You don't need to understand options trading. You don't need to read financial statements. You don't need to know what the Fed is doing. You just need to start. Because the biggest risk you face isn't market volatility. It's the risk of reaching retirement and realizing that your fear cost you decades of compound growth. It's the risk of staying exactly where you are. You've got this. Your brain is trying to protect you. Thank it, acknowledge it, and then do it anyway. I'll see you in the next one.